Hello everyone, this is Nick Perry at Schaefer's Investment Research with your chart slideshow for Friday, August 3rd. Today I'm back with my weekly check of the broad market indices. Last week's chart slideshow came on the big market down day, the day the Dow lost 300 points and the entire market was hit. And at the time, I said we were at short-term support, still above intermediate-term support, and the takeaway was that the action felt worse than it looked on the charts. When we turn to this week's charts, we see that we've seen a little bit further selling, but the charts still don't look that bad, and it's kind of tough to say that just given how whippy the market's been and how volatile. It feels like we're really getting hit, but when you look at the action in this perspective, look at the SPX. We were holding at that little short-term support last time. We've now pulled back to this intermediate-term support, and we've been consolidating there. As far as the Dow goes, it's actually still holding at these lows here. And the comp, basically, those lows, this area we'd been watching, that support just above 2,500, kissed that and still holding above it. The rut we've discussed got hit hard last week. That was one I had basically calling sleepy and was clearly wrong on that. But even in that case, you're still holding above these lows here. So, in a nutshell, we have seen selling. It's been incredibly whippy, incredibly volatile. But as it stands at 10:47 on Friday, we're still holding at support. So I want to talk about this chart, which I've been discussing in the blog. This chart shows the percent of ETFs from a list that I track, the percent that are nearing oversold levels. And basically what I do is calculate that, sum it up on a daily basis, and then plot that against the SPX. The idea is that when two-thirds of the list are hitting extreme oversold levels, that tends to be an exhaustion point, where selling is broad-based enough that the market tends to be close to finding its footing. In the blog yesterday, I presented this chart with a long list of caveats. Hopefully I didn't scare anybody off when talking about that. But basically, what I tried to do was quantify what has the market done after we've seen spikes. And, as I mentioned in that blog post, this is a relatively small sample size, so keep that in mind. But, when you're looking at the average, what you tend to see is for the first few days after the spike, the action is still volatile. And in this case, we saw that at 10 days here, the average return was slightly negative. Now, based on that methodology, our spike would have started counting on last Friday. So we would be 5 days into it, so which just puts us right here. If it did follow this historical trend, and there's nothing that says it has to, what we would expect to see is some slight possible downside action again next week, and then after that tend to see things pick up. And again, as I noted in the blog, after 50 days, more than 80% of the signals were positive, and for an average return of something just north of 3%. I wouldn't make any decisions solely on this data. Again, it's a small sample size, and there are some biases built in by me on this. So, kind of pulling this all together, basically we've seen this initial drop in the market. We'll look at just the SPX, and now we're in this consolidation phase. Based on the ETF data, it would seem to suggest we could be closer to a bottom, but that data also would suggest that the next week could still be kind of rocky, potentially dipping down into the middle of this zone here. Alright, I'm going to be out of the office for the first 3 days of next week, but I should be back in the office on Thursday, so I should have a new chart slideshow put up by then. So, my blog will be updated by some of my colleagues, so make sure you stay tuned for that, and I'll return next week.